Right, cool. Let's start it. So hopefully everyone that had a good weekend. Everyone is rest and ready for another week. We did add the release from the NFP last Friday. So let me share my screen, sorry. All right, so as I was saying, I hope everyone had a good weekend, ready for another week. This week is very volatile. As we know, we're going to have the CPI tomorrow on Wednesday for the USA. Very, very awaited data, okay? We have the FOMC next week on the 18th of September coming up as well. Market is specifying a 25 basis point cut, but still a lot of uncertainties around how the direction and how the approach of Jerome Powell will be towards that. So we're going to discuss a little bit about that. As I say, we did add the release of NFP last Friday, so I do bring some interesting points because the NFP somewhat was bad, but it reflected good into the US market. So if we open the US dollar index, let me just grab it for you in a second, we can see that it did react positively and it's still going up, right? Still with some bullish move for the week. So we've opened up the week on the price of, what was this, 101, let's call it 101,200, and right now is at 101,600, so 0.4% higher, 0.5% higher than the beginning of the week yesterday. So there is definitely something happening on the US market from the US releases, and I've brought here, so we're going to discuss about that as well. And to finish up today's webinar, we're going to be looking at the USDJPY carry trade. A lot of people have been talking about these carry trade, as we can see here on the chart. USDJPY have been crazily, has done some crazy moves since 2022, and hopefully some of you could catch this huge move. All started in 2021, in January 2021, and then it ended this carry trade on July this year in 24, and right now we've seen these 15,000 points drop, so 150 pips, no, 1,510 pips move to the downside, and some people are saying that the carry trade is over. Some people are saying that this is just a pullback. So we're gonna dive a little bit deeper and understand why the Japanese yen is strengthening as it is at the last couple months. Okay, so let me just note it down, everything what we're going to be looking today. So let me grab it here. All right, first thing, I think we should start with the NFP. All right, NFP, and why the market is reacting positively, even on a bad market, even on a bad release. Sorry, someone is trying to join us here with double account, so it's interesting. Okay, hopefully it goes now. So why the market is reacting positively for the US dollar, even when the release was somewhat bad. Okay, second point, I think then we can jump to the US, well, not the USD, the Japanese yen carry trade. Japanese yen carry trade. And the topic will be, is this over? Okay. And last but not least, of course, the CPI from USA plus the ECB. All right. So we have CPI from USA, US CPI plus ECB on Thursday. So it's a full a packed week. All right, so we have on Wednesday the CPI, on Thursday the ECB, and it's going to be really nice to trade euro dollar, to be honest. So this is going to be the topics we're going to be discussing today. So first, NFP and why the market took these as a positive aspect when it was a negative, and second would be the JPY carry trade. And is this over? We still can get some negative moves. We can still get some sell-offs on the Japanese yen and maybe to carry a USDJPY long trade. Well, we're going to be looking into that today. And finally, is the US CPI coming higher? Is it coming lower? What are my expectations? And what will the ECB say? So let me take a screenshot of this. Perfect. Here we have it. What's, oh, there you go. All right. Delete everything. What? Why is not? Oh, there you go. Cool. Perfect. All right. So everyone knows that every first Friday of every month, we have the release of NFP, right? NFP is a very, very good indicator to see how the market, the labor market is on USA. We do, it's interesting, right? Someone asked me, does Australia have NFP as well? It does. Every country has NFP, but it's not as expected as the USA NFP, all right? And there are some reasons for that, of course, but mainly because USA is the, well, it's what they call to that's what they want to us to say, right? The biggest economy in the world. I somewhat disagree with that, but anyways, so it's the biggest economy in the world. So all the eyes are, of course, eager to see the data coming from USA. Not only the NFP, but all the CPI, all the FOMC rate decisions. Everyone always says US dollar is the king. US dollar will always win, whatever happens, whatever it does, this and that. But in essence, it was, okay? Because we're doing a very slowly, but we're getting there and making a transaction from a hawkish FOMC to a neutral FOMC and to a dovish FOMC. So slowly we are changing the path where the US dollar is going, and it's really clear for us to see if we zoom out the picture here and put it on a daily chart. Let it load for a second. There we go. It's really clear to see that from the from September in 2022, we've seen this decline on the US dollar. So if we look at the picture right now, what is happening here is, I think everyone can see it. It's very simple to see it. It's a consolidation, right? So a consolidation between the levels of 100 to 107,000. Will this continue, or will this break the trend below here? Let me change the color of this. So will the trend continue to bounce from 100, right, as we can see here, 3-4 times, to then go to somewhat around 105, 500 to the maximum of 107? That's where the US dollar is trading at the moment. And interesting enough, of course, most of you probably know this, but the US dollar index is pretty much a opposite of the euro dollar, right? So if we make these, all right, clear all the drawings, take this off, make these invert. Where is this? Invert scale, there we go. This is euro dollar. All right, so it's pretty funny to see, because even if we add euro dollar on top of this chart, Forex, euro dollar, new price scale. Still loading. I think my internet is a little bit slow today. Anyways, so as we can see, it's exactly the same. So whatever the euro dollar is doing, the US dollar index is doing the opposite. All right, and of course it affects positively the euro dollar. So if the US dollar is going down, euro dollar is probably going up because the US dollar in this case is the quote for euro dollar. All right. And whenever the quote goes down, whenever the quote loses value, the base gains in value, therefore market goes up. The opposite happens as well. Whenever the base loses value, in this case euro, the quote gains in value, the US dollar, and therefore the market goes down. All right. All right, let me take all of these off and come back to the economic calendar. Let me bring up the NFP. NFP Saturday from here to here. Perfect. This is what I like about FinLogic's economic calendar. It's very handy, very, very handy. All right. Labor market, non-farm payroll. That's the one we want. Click on top of it. So as we see here, we've had a actual of 142,000 from a forecast of 160,000, and the previous revised it down. Okay, so that's important for everyone to know. What's a problem of revising down? Okay, let me grab my pen here again. So when we have the actual forecast and previous is basically showing, the previous is showing what was the last release. Okay, so in this case, the month of August. So last release, and we can see that the month of August wasn't 89,000, it was 114,000. Okay, so that was revised down. So what basically means is the BLS, the Bureau of Labor Statistics, that is where this data is gathered from USA. So the BLS, it's a public website. Everyone can go and look it up. Oh, it's a Bureau of Labor Statistics. It committed a little mistake, as they like to say, and put it a wrong number. But what I find interesting here is that they've reduced to, let's call it a 90,000 here just to make the math simple, and let's call 114,000 on here in the last release. So they've pretty much got wrong 24,000 jobs. All right, so they got wrong 24,000 jobs, or did they make this in purpose, inflated 24,000 jobs in purpose, just to don't look as bad as it would? Right, so that's the question. It's just a speculation. I don't like, it's not 100% true here. These are the facts. They manipulated this and this and that way. It's not. All right, sometimes it is, sometimes it's not. It's just, it happens to be. All right, but whatever, the previous was revised down to 89,000, so that's very bad already. That forecast was 160,000 and the actual came in 142. So somewhere around 18,000 lower than expected. And we did have as well some people mistake to look at only at the non-farmer payroll. Yes, the non-farmer payroll is really employment, it's really important, but you can't forget to look at the unemployment rate, sorry, and the average hourly earnings. Okay, so we have it here, the three main topics of the NFP. Don't look at only NFP, don't look at only unemployment rate, and don't look at only average hourly earnings. You have to look at these as a group, all right? And whatever they do, they will make a move on the market. So if all of the three, that's how I like to trade NFP day on Fridays, okay? If all of the tree comes in higher than expected, that this wasn't the case. I always say this on my videos as well before the NFP. If all of the tree combined comes in higher than what was expected, therefore it is a good possibility for longing US dollar. So therefore shorting euro dollar, shorting longing USDJPY, longing USDCHF, and etc. USD CAD, and it goes. But if all of them come lower than expected, because this wasn't the case as well from last Friday, then I will be looking to short the US dollar. because this will be negatively impacting the economy. Negatively, investors will be looking to it as, that doesn't look too good for me to put my money in there. So therefore, we'll step back a little bit and wait to calm down. Or at the moment, I will take my money out from USA. And what happens? This is a simple question. I want to see if anyone knows the answer. What happens with when someone takes the money out, say they liquidate the assets on a certain stock and they are holding a huge position, or like 60-70% of the position of the stock is held by one person. If that person tries, well, wants to, and goes and liquidates that position, what happens with the stock? Does the stock continues to go higher because now there is less money, but the division of money will go to much more people? Or does the stock continues normal, or does the stock drops? All right, someone send us an answer here. QD, sorry if I pronounce your name wrong. So the stock price will drop. Yeah, that's correct, because someone took a huge portion of the market with them when they left. Therefore, there's no much money left on the table, and therefore there's less liquidity, so the market will drop. And that's exactly what happens when big investors takes the money out from a fixed income or from a bond. The bond will drop, because not because of the money getting out, but because the investors around the globe looking as a not safe as it was anymore. Therefore, I don't want to put my money in there anymore. So it's just a little different correlation between stocks and bonds, but it's all the same in the end. All right. So we've talked about NFP. So the non-farm payroll, as well as the private employment, they came in below expectation. That's what we call a Goldilocks. Okay. Does anyone know what's a Goldilocks? Otherwise, I can just explain as well. So no one? Okay, cool. Not a problem. I will try to explain in simple terms, just finishing to explain NFP first. So the NFP came in lower than expected. The unemployment rate came in as expected, but I've mentioned this already. Jerome Powell has been stating on his speeches that unemployment rate is, it's not high, it's this and that. It was already, we've had much higher unemployment rate, because he needs to say that. Imagine we're having 4.2%, 4.3%, 4 to 4.3% unemployment rate, and the chairman of the central bank comes in and say, look, we are really not on a good scenario. We don't know what we're going to do. So they can't come and say these types of things. So, of course, already expect something good to come out of them, all right? At least neutral to good. They're not going to tell bad stuff. So we can't control inflation. We can't get ahead of unemployment. We don't know what else we should do. Please help us. No, they can't. Otherwise, the market would be a mess. Imagine if Jerome Powell comes into the meeting and say, look, guys, we lost control of inflation and we don't know how we should proceed anymore. What would happen, right? It would be a massively crash on the US dollar. Why? Because everyone would be, all the investors that I've just mentioned about liquidating assets, they would liquidate assets on US and put into a safer place. That in this case, already doing a little sneaky peeky here, would be the Japan. Okay. So Japan right now is paying much better than US, much better than Australia, and not at the moment, but the trajectory, but the preview for Japan paying better yields than Australia, US, Europe, it's much higher than it would be if you leave your money with Australia, Europe, or USA. Okay. So yes, unemployment rate came in at 4.2 as forecast of 4.2. The previous was 4.3, so not revise it down, so that's good, or not revise it up in this case, sorry. But look at how interesting it was. We had we were, all right, sort of controlled when the pandemic started. Let me just go back here. 2018, okay. Somewhere 2018, normality was between 3 to 4, okay. And then we went all the way up to 14% in 2020, all right. This, of course, is due because of the COVID, as we can see here. This was on the 3 of February, January, February, March, May. No, sorry, April, and this was in May. So 8th of May 2020 was when all the COVID actually got really bad, and a lot of people got laid off. A lot of people got, without jobs and couldn't pay mortgages. A lot of people lost their houses. So that was really, really bad in a sense. And therefore 14.7% unemployment rate was considered to be low for for Jerome Powell. All right, so I don't know what's high for him. Anyway, so moving on. They control it. People got back into jobs. 6%, 5%, 3.6%, and everything was back to normal in 2022. Half of 2022, June, July, everything was back to normal. But what just happened? We lost control with the unemployment rate again, and we are back to 4.2. So if we notice, since May this year, 2024, so there is 4 months already that we are only having higher and higher unemployment rate. Okay, and that's really not good, because it's just showing to us that, yes, well, not showing to us, but showing to investors that, yes, USA did had some control over the unemployment rate. They were doing a good job towards bringing down the inflation. As they say, the dual mandate, as I've always mentioned about that, the Fed has a dual mandate. They bring down inflation while maintaining while maintaining people employed, and controlling the market. Okay, the OMOs, the open market operations, reducing the balance of the assets, reducing the bonds they're holding, to reduce the expectations, to diminish the expectations of the rate cuts. And that doesn't look too great at this moment. So what I think is there are some major uncertainties, right, in the cycle of the balance sheet of the Fed, and even though that the central bank has reduced, right, its assets by almost, if I'm not wrong, $2 trillion since 2022. That was the peak when they reduced, and that was exactly when, if we come back here, 2022, 3.7, that was the normal. Okay, so reduced to $3 trillion since 2022 peak. The balance sheet will remain about $3 trillion above the pre-pandemic level. So it's unclear for me, all right, how they will clear this $3 trillion in 4 months. And not in 4 months, but they've took since probably around 1.5 to 2 years to clear $2 trillion. So they have another $3 trillion to clear, because these are all, what I want to say here is they've printed so much money that they have to grab this money back. So it's quantitative easing, quantitative tightening. Have you guys heard about QT and QE? I've explained this a lot of times already, but quantitative easing is when, oh, okay, cool. So Tisha say yes, that's awesome. All right, so quantitative, very, very broad here so everyone can understand what I'm talking about. Quantitative easing is when the central bank is giving out money, is printing out money. Quantitative tightening is when the government, quantitative easing is often used on pandemics, as we saw. Yeah, I've explained that on a previous meeting. That's correct. So it's often used when the government or when the central bank wants to stimulate the economy or wants to give it out money to people so they can live for some tragedy that have occurred, a natural tragedy like the COVID. Okay. And quantitative tightening is now, we want that money back. So we need to take the money off from the economy, because otherwise, if we leave that money in there, the $100 bill is not worth $100. It's worth 50. So it's 50% depreciated. What they will do is they will be selling bonds. They will be buying back bonds. They will do the open market operation. Well, there's so many things that they can do depending from each central bank, but that's what the Fed do. So back to here, now they've cleared $2 trillion. Now they have to clear another 3 trillion. Okay, because remember, they've printed $5 trillion since 2022. That was the peak. Clear 2 trillion, has another 3 trillion to above what the pre-pandemic levels, I would say. So it's unclear how long for me the Fed will take, and how long the Fed can continue to reduce the assets that they're holding, while now, very important to say, they're going to start cutting the rates. Okay, so, or if they are having a larger balance sheet size, will become the new normal, right? So that's another question that it's a little bit too in-depth, but if this right now, the $3 trillion above what they've set already is the new normal, and they continue to cut the interest rates, then the US dollar will, of course, be less valuable. So that's another trade opportunity on shorting US dollar. So the market is full of opportunities at the moment when you look to a fundamental perspective of view. All right. Like euro dollar, it's going to be worth much more than the US dollar. Stocks as well, plunging in and everything. All right, so we have a question here. I have a question regarding which one is done first, quantitative tightening or interest rates change. You mean, so let me see if I got your answer correct. So if quantitative tightening is done first, then interest rates change. So if they hike interest rates first and then they do quantitative tightening, or if they do quantitative tightening and then they do interest rates, hiking interest rates. So just let me know about that and we'll get back to your answer. And last but not least, the average hourly earnings. Okay, so we've had a better result than expected and better than the previous. So that's really good. That's something that, you know, makes USA citizens probably very happy. So they're getting paid 0.2% more than what they were paying in the last month. So effectively, of course, it's not like that month by month the salary raises. It's on a yearly basis, probably. I've never been to US, so I don't know. Anyway, so actual was 3.8%, forecast was 3.7, and the previous was 3.6. So as we can see, 0.1 higher than the forecast. That's good, but 0.2% higher than the previous. So that is really good. Now, when we back it up all of the trees, so we had a really bad NFP plus a reduction, a lowering the previous. So that's really bad. I would give it a -2. Oops, sorry. So I like to rank. Okay. So for those who are new here, maybe we have some new people. I think I've never saw Rodney. I think I've never saw as well Chukwudi. Yeah, most of the others I've seen it. So for those who have the first time, so I like to rank my NFP on this way. So +2, +1, 0, -1, and then -2. Okay, so we have 3 releases, as always I say, NFP, average hourly earnings, and unemployment rate. If NFP was really bad and revised it down on the previous, I give it a -2. Okay, and then we move on and go to the unemployment rate or whatever. So we had a neutral, nothing. All right, so it was as expected, but it was lower than the previous, so that's good. So I give it a -1. -1. And then the last is, I can't see it because the camera is there, I have to put my head down. And the last is the average hourly earnings. So that was 0.2 higher than the previous and 0.1 higher than forecast. I give it a 1. So then we just do the math. So let me do it here. So -2, -1, and then 1, +1, sorry. Okay, let me delete all of these to don't confuse you guys. Perfect. All right. So -2 plus -1 is -3, +1 is -2. All right. So we have a -2 for the NFP. In my instance, this is very dovish, and I take this approach as shorting the US dollar. All right. So that's my analysis for the NFP. I know a lot of you were asking about on the YouTube and etc. So I've thought diving deep into it would be good. Now, coming back to the question from Satish. Yes, okay. So it doesn't have a proper way to be done. Okay, so usually is at the same time, because it's always on the same meeting that they will decide whether they will hike or maintain the same, or pause again, or cut the interest rates. Plus, what do we do? Quantitative easing or quantitative tightening? But you have to understand that quantitative easing is always done, most likely to be done first, because they have to give it out money to be doing quantitative tightening. So if they give it out, as I've just mentioned, $5 trillion for this whole thing that we've had with the pandemic, they didn't now to do a quantitative tightening and get that $5 trillion back, or maybe 80% of that portion. Otherwise, the money won't be value as it was prior. Okay, of course it wasn't. Of course, it's not going to be as valuable as it was before COVID. This will always be a little, maybe 0.1, 0.05% depreciation of the currency, of the fiat currency. But they try the best to minimize these by lowering the interest rate. So it's a tool that has to be combined with the interest rates, whatever hiking or cutting the interest rates. Okay, my personal opinion on that is that the quantitative easing should be done first, and then the hiking, and then the hiking phase. So let me write this down. So quantitative easing should be done first, and then the second step would be hiking the interest rates, and then the third step would be quantitative tightening, while at the same time lowering the rates. Okay, hiking rates, lowering rates. So that's what that's what I think in terms of financial models would be more how can I say that, more controlled towards the economy. But the Fed, who am I? Who am I to say something that the Fed has decided to do or whatever? But classical economic theory always say that it has to be work combined and together. All right, and that's a central bank decision, nothing with the government or politics involved. Well, that's how it should be, at least. All right, cool. All good. All right, let's go for second topic. And the Japanese yen and the carry trade. Not a problem, Satish. Thanks for your question. Right, so the Japanese yen, we don't have, where's the chart now? Oh, I've left it here. Just a second. Chart. USDJPY. There we go. So one thing I would love for you guys to understand is that when I talk about Japanese yen, I'm talking directly about the currency Japanese yen. I'm not talking about USDJPY. I'm not talking about eurusd or any backed currency. We call this backed currency. When you want to talk about one specific currency, you just say Japanese yen or euro trade or US dollar trade, and etc. So what we'll be talking about is the Japanese yen trade, not USDJPY. Okay, so the Japanese yen carry trade is often realized on against a stronger currency. Okay, Japanese yen has is known by the weakness that it can provide for the carry trade. This is why it's a good carry trade. But of course, there are some things that you have to pay attention when doing a carry trade on CFD, like commissions and swaps, that it can often it's good, but sometimes when you get higher drawdowns or you don't get on a good point of the market, the swaps can be higher than your profits. Therefore, you will be paying more swaps than profits. Okay, so the Japanese yen carry trade often happens when one central bank is very hawkish against the Bank of Japan central bank. We've seen these happening since 2021, if I'm not wrong. Let me just zoom out here. There we go. This is a daily chart, okay, guys? So yeah, since since January 2021. So the Japanese yen index is a mirrored image of the USDJ. Yeah, correct, because it's a basket, right? So the biggest portion of the basket goes to the USDJPY, and then EURJPY, CHF-JPY, and goes like that. So whatever happens on the Japanese yen it's exactly the same thing as I showed on the beginning of our webinar. When the DXY is going up, Eurodollar is going down, because it's the mirrored version of Eurodollar. All right, goes exactly the same for any other currencies on the Forex market. All right, so we've seen the carry trade unfold on Japanese yen since January 2021. We had this huge rally to the upside to October 2022, and then we had a pullback to beginning of 23, and then it's starting again 23 all the way to beginning of 24. Rally back down, and then 2024 we had a huge push, breaking all-time highs for Japanese yen, USDJPY, sorry, reaching 161,000 or 162,000, can't remember, and then in June, and then dropping very quick all the way down to where it is right now, $143,500 for one Japanese yen. Now, how some people are approaching this is they think that this is a pullback, and exactly as it happened on here and here, and then they're thinking that this is a pullback. So they're thinking that this is a pullback to come back to highest to 170,000. Sorry. My honest opinion is that it's not, and the carry trade on the Japanese yen has come to an end. And the simple answer is we're going to have a cutting FOMC. We're going to be looking at a Fed much more dovish than it was since the beginning of this year, since 2021, right? When the Fed was much more hawkish, approaching towards, yes, we will hike another 25 basis point. Yes, inflation is still out of the range, and to bring down, we continue to hike inflation, we continue to hike in rates, and etc. etc. So these brought to the market a lot of investors around the world, right? While the Bank of Japan was, we're not going to hike because we're still on negative territory for the Japan, and it has been for more than 30 years, right? So Japan has had a negative interest rate for, I think, 30-something years, 32 years, or around those numbers, if I've on top of my head. And now you imagine you pretty much borrowing money from somewhere that you don't pay back, you don't pay any interest back, and investing that money somewhere you're getting 5% a year. All right, so you're pretty much taking money from Japan, converting to US dollars and putting US dollars. So you're taking money out of Japan and making this a US dollar currency and putting on USA, sorry, and that is generating to you 5% a year. All right, therefore, people are much more inclined going to US dollars than going to Japan and buying Japanese yens. So the demand for US dollars will be much higher on the demand of the Japanese yen. And we've just seen as well the Japanese market crashing a couple of weeks ago, if not last week. And same as NASDAQ and Microsoft, NVIDIA. So there is a lot of opportunities happening on, I was actually looking at NVIDIA last Thursday, and I was like, oh, it's on a range and it's on a support. The risk reward is much better for going to the upside than to the downside. Maybe it's worth entering the market at the moment. So, but anyways, so back to Japan. So I would highly get a 5% than a negative, right? So people don't look to Japanese yen. People look for US dollars. So in this case, that's why the trade unfolded. But now it's different. So now it's completely different. Remember when I've mentioned that the FOMC was much more hawkish than any other central banks on the 2021, and it continued to be until beginning of this year. Well, until end of this last year, sorry, 2023, yeah, because they were already talking about cutting the rates. There were speculation last year in October that the Bank of Japan would hike 25 basis point trade, 25 basis point on the interest rates, but that didn't happen. It only unfolded on this year, right, in June, when the Bank of Japan hiked 25 basis points. So then the trade is over, because now we have a positive ratio for the Japan and a continuation of a positive ratio on the FOMC, on the Fed from USA. But the tricky thing here is that the FOMC is not looking to hike anymore, as of the Japan now is looking to continue to hike in December, another 25 basis point. Where they came into the meeting and talked about, yes, we most probably continue to hike another 25 basis point on here. So therefore, we've just swapped the scene. Now, Japanese yen is stronger than the US dollar. And yes, I do believe a continuation to the downtrend on the USDJPY. Until where? That's a very good question. I don't have any target on mind, but let me clean all of this and zoom up here. But I'm expecting it at least, right, to break these lows. And once it breaks this low, to come to this level of 134. Okay, so that's my expectations for USDJPY. And I do believe that the Japanese carry trade is over, and therefore I will be looking to long Japanese yen, not only against US dollar, for instance, Australian dollar, euro, pound, and etc. So very weak currencies compared to the Bank of Japan, how it's been. All right. All right. Last topic: US CPI plus ECB tomorrow. Sorry, well, US CPI will be tomorrow, but ECB will be on Thursday. I think USDJPY will go down because dovish US dollar versus hawkish Japanese yen. Yeah, that's correct, Satish. That's exactly it. All right, where is CPI? There we go. Here you go. USD. Let me close all of these. Inflation rate month over month. Core inflation. And year over year. And core rate. All right. So the expectations for the month over month is to be 0.2 from a previous of negative 0.1. Interesting. The core inflation month over month is expected to be 0.2 from a previous of 0.1. The year over year is expected to be 3 from the previous of 3. And the core year over year is expected to be 3.3 from a previous of 3.3. So let's just do a simple overview here. So if all of these comes in as expected, 3.2 from the previous of 3.2, sorry, 3.2 from the previous of 3.3, the year over year comes in at 3 as expected, and the previous as well. The month over month comes in at 0.2 from previous of 0.1, and The month over month as well comes in at 0.2 from the previous of negative 0.1. I do believe that for the labor market that we're having, and the unemployment rate being consistently as it was, most probably we're going to continue to have a decreasing on the inflation from USA. The simplest trade here that we could have is shorting US dollar, shorting US dollar, right? It doesn't matter for which currency, then it's your trading, setup. You will decide that. But in my perspective, tending that there is no people working, there is people getting paid, yes, a little bit more, but less people working. So therefore, less people to spend money on the economy, less people to generate inflation, as we've discussed this already so many times on here. So in the end of the day, most probably we continue to have a decreasing on the US inflation. Not only me saying this, but the FOMC has said this on the last meeting in July. Okay, so they are looking to inflation, decreasing inflation, and inflation to get back to target in the second half of 2025. I completely agree with that. I just don't agree with a 50 basis points cut. Okay, I agree with a 25 basis point cut. And these can change pretty quick if it's inflation, if I'm wrong and the inflation comes in higher than expected for all of the fall. Okay, year over year, core year over year, month over month, and core month over month. Remembering that the FOMC, the Fed, the central banks, they pay attention on the core more than they pay attention on the CPI, the normal CPI, because the core CPI, they can the items that they can control, they can see if what have they done in the past is actually making sense to the economy. All right. And last but not least, ECB. Very tricky, right? Because if we look at here, let me grab it to you. Oh, sorry, I have to disinvert these because there we go. Cool. All right. So the Europe 2-year bonds is dropping pretty quick from all the way up. Was 2024? 24 here, there we go. Since May 24, when we had 3.1%, we've dropped to 2.1%. So that's a 100, well, it's a full 1 basis point. So that's pretty much, there we go. Yeah, that's a full 100 basis points. So I don't believe on a 100 basis points cut for this year on the ECB, but remembering that they've done a cut on 25 basis point, and is most likely that they do another 25 basis point cut. But the rhetoric from the ECB will be most importantly. What I think is that they will be following a very data-dependent approach. And that's what Christine Lagarde will be saying, as she always say, we're going to be looking to incoming data, and we have to look at how the market will react to these cuts that we've done to decide the next upcoming meetings. So my opinion is that from the ECB compared to, if someone wants to trade euro-dollar for this instance, from the ECB compared to the FOMC for next week, I do believe that the ECB will be much less dovish than the FOMC. And at the FOMC, there is much more precified cuts for next year than that does for the ECB, because the ECB is sort of doing great on the CPI, so they don't have to rush to cut the rates at this moment. All right. As of the FOMC may need to rush to a little bit to catch up with the curve of the inflation and the rate. I've explained this already here as well. Unfortunately, we're running out of time, otherwise I would explain again. But very simple terms, same thing apply that I've explained on the Bank of Japan and the FOMC. Same things apply here from the ECB and the FOMC. Most likely, compare it to scenarios here, most likely that the ECB will be less hawkish, less dovish than the FOMC. Therefore, the trade that will unwind here to us, the opportunity that will unwind here to us, would be euro dollar to the long side, and the risk reward to euro dollar to the long side is much higher than looking to the short side. So in my portfolio, I will be looking to euro dollars long, but you know, everyone has different strategies. You may have your strategy. This is not a signal. I will always say that. So make your own analysis as well. All right, guys, so we've come to an end. As I've mentioned to everyone, can you guys see my screen? Let me check. Yes. So we've talked about the NFP and why the market is reacting positively to the data. We've talked about the Japanese yen, the carry trade, and is this over? And we've talked about as well the US CPI plus the ECB for this week. That is the most important, I would say, for the second week of September. Guys, I see everyone tomorrow on the video, or I see everyone back here on Thursday, 5 to 6 p.m. If you have any questions, please, I'm always on YouTube. You can comment in there and I will have a time to answer everyone. All right, guys, thank you so much. I see you in next Thursday here, back again, 5 to 6. And this is it. Thanks, everyone. See you. Bye-bye.